What if I told you that inflation, long demonized as the villain of our economy, was quietly re-engineered by central banks into their most effective weapon? What if behind the familiar story of rising prices, interest rate hikes, and tightening belts, there lurks a far more subtle, insidious mechanism? One that turns inflation into an instrument of statecraft, power projection, and financial tethering. Today, we're going to peel back the veneer of mainstream economic narrative, reveal the hidden mechanics of how central banks can use inflation rather than just fight it, and trace the path from early monetary experiments through crisis, collapse, revival, and modern echoes. By the end of this, you'll see inflation in a whole new light. To understand this twisted story, we must first meet the key institutions and figures. The term central bank is so familiar now, but the path was long and winding. The Federal Reserve System, the Fed in the United States, the Bank of England in the UK, the European Central Bank in Europe, all these emerged as critical actors in modern money governance. In the gold standard era, central banks were largely about currency stability, lender last resort functions, and managing the banking system. Cleveland Fed +2. But somewhere along the line, things changed. A quiet shift occurred. Inflation, targeting, monetary policy activism, fiat money dominance. The public narrative still portrayed inflation as a runaway beast to be tamed. Yet, inside corridors of power, a deeper calculus was forming. And yes, there is a twist. Our belief that inflation is solely a failure of policy or unchecked spending misses a far more calculated dimension. Inflation is not always just bad policy. Sometimes, it's policy. Let's begin the story. Back in the day when money was tied to gold and convertibility-bound governments, central banks had limited discretion. They could issue currency, clear payments, bail out banks, but they were constrained. Then came the major shift, the abandonment of the gold standard. The rise of fiat currency, large sovereign debt burdens, and the increasing need for governments to monetize liabilities. Once currency was backed primarily by trust rather than gold, a central bank had more scope to influence price levels, credit, and inflation. One key milestone, the Nixon shock of 1971, where the US dollar's link to gold was effectively ended, freeing the Fed and others from old constraints. With that move, inflation didn't only become a risk, it became a tool. Which brings us to our next phase. In the 1960s and 1970s, Western economies experienced what's known as the Great Inflation, sustained double-digit inflation, rising expectations, and wobbly confidence in central banks. Publicly, inflation was the enemy. But behind the scenes, central banks began realizing something, that by managing inflation expectations, aligning interest rate policy, currency devaluation, and credit expansion, they could influence economic structures, redistribute debt burdens, and recalibrate power. Here's how. By allowing inflation, they could erode real debt burdens, especially for governments, weaken real wages, giving corporations more leverage, devalue currencies, boosting exports relative to imports, and create an environment where financial and political compliance mattered. Put plainly, if you can covertly engineer inflation, you can shift wealth, advantage producers or export sectors, discipline labor, and free up debt obligations. That's not a conspiracy, it's incentive structure. But the key is subtlety. Inflation must be managed, expectations anchored, narratives controlled. Central banks thus become the stage managers of inflation rather than just its fighters. But this tool has limits. The Great Inflation broke those limits. By the late 1970s and early 1980s, the Fed under Paul Volcker launched an aggressive campaign, raising interest rates to historically high levels to tame inflation. What happened? Inflation came down, but at a cost. deep recessions, high unemployment, social dislocation. The tool had been overused. Inflation had become the switch from inflation weapon to inflation enemy was explicit. Central banks learned a lesson. You can deploy inflation as a tool, but if it gets out of control, the backlash is enormous. Credibility matters, expectations matter. That realm of subtle inflation engineering collapsed, and a new era of central banking began, focused on inflation targeting, central bank independence, transparent communication. Fast forward to the 2020s. The world confronts inflation again, spurred by pandemic shutdowns, supply chain disruptions, and massive fiscal stimulus. The European Central Bank, the Fed, and others scramble to raise rates. But this time, the manipulation is more complex. Inflation isn't just from spending surges, but is influenced by supply shocks, geopolitics, and climate policy. Here's the unsettling question. Are we witnessing an era where inflation is quietly being used as a weapon, not just fought? Consider the motives. When inflation rises, government debt burdens shrink in real terms. Having run heavy deficits during the pandemic, governments may quietly benefit. The data is shocking. Inflation in advanced economies surged to double digits after decades of stability. Real government debt burdens fell as inflation rose. Central banks' balance sheets ballooned, expanding their power. If inflation is a weapon, everything shifts. Your wages may fall behind, your savings erode, and wealth is redistributed. It becomes a policy chess game. The hidden power lies in steering inflation expectations. If a central bank convinces everyone that inflation will be, say, 3% or 4%, behavior shifts. People accept lower real wage growth, and the tool works invisibly. 3 clear takeaways. 1. Inflation can be strategic, used for economic re-engineering, like debt reduction. 2. A central bank's real power is shaping expectations. 3. The old rules are gone. We must now watch not just the rate of inflation, but the strategic motives behind it. Here's the caution. If inflation becomes weaponized, invisible damage accumulates. Real wage stagnation, squeezed savers, shifted wealth from labor to capital, hidden transfers between sectors. All these are set effects that might not be acknowledged. We may wake up to the consequences only after they're baked in. In short, we must ask ourselves, when inflation surges, who really benefits and who loses? Is the central bank merely fighting the monster, or is it wielding the monster? If you found this exploration illuminating, hit the like button and subscribe for more deep dives into the hidden mechanics of money and power. Leave a comment below. What do you think? Is inflation being wielded as a weapon, or is it still just the enemy? And don't forget to share this with someone who owes you money. You might be paying them back in weaker dollars. Thanks for watching, and stay curious.